Get ready. There's a major shift happening, one that could really reshape your financial future. We're talking about the Federal Reserve, the independent body guiding our economy. And right now, it's standing at a critical turning point. What's going on? Well, recent data shows a pretty surprising slowdown in job growth. It's actually hit its lowest level in 5 years. And that's not all. Consumer spending, it's taken a sharp decline, first time since 2010, if you don't count the pandemic disruption. So the economy's cooling. But there's still some, lingering inflation pressure, partly from tariffs, labor shortages, and all this is pushing the Fed towards cutting interest rates. It's a big policy reversal, and it's going to directly impact your borrowing costs, your investment returns, the works. But here's where it gets really interesting. This crucial decision, it's happening right in the middle of some intense public pressure, specifically from the White House, and that's fueling some serious concerns about the Fed's independence, that long-standing idea that they operate separately from politics.
Exactly.
Yeah.
And this really brings up a critical question. Is the central bank going to stay focused on, objective economic stability? Or could this political influence steer its course, which potentially risks higher inflation down the road? That's the worry.
Yeah, it's a really delicate balancing act, and it could affect everything. I mean, from your mortgage rates to how strong your investments are, even the stability of the dollar. So in this deep dive, we're going to cut through the noise. We're looking at the sources you shared, trying to show you exactly what's happening, why it matters, and maybe how you can prepare. Okay, let's unpack this. Our mission today, we've got this stack of sources, articles, research notes, and we want to pull out the most important nuggets of knowledge for you, kind of give you a shortcut to understanding this really complex picture.
It's fascinating, isn't it, how all these different things, the hard economic data, what's happening inside the Fed, and then this political pressure from the outside are all converging. It's creating this moment of, both uncertainty and opportunity, frankly. We'll try to connect the dots for you between the numbers, the Fed's thinking, and what it means for your money.
Right. So let's start with the economy itself. Why is the Fed even thinking about cutting rates right now? It really boils down to some pretty clear signs the economy is slowing down, maybe faster than people expected. Take the July jobs report. It showed these downward revisions. Basically, job growth was weaker than we first thought, much weaker.
That's spot on. And the key thing isn't just that it's slowing, it's the speed of the slowdown. That 3-month average for non-farm payrolls, just 35,000 jobs added. That's, the lowest in 5 years. And at the same time, unemployment, it's ticked up, now at a 33-month high for 4.2%. These numbers, they're not just blips. They paint a picture of a labor market that's definitely faltering.
And it's not just jobs, right? Consumer spending, which is usually the economy's engine, it's really lost steam. If you adjust for inflation, spending has fallen sharply these past few months. In fact, the annualized rate, it actually went negative. First time since 2010, again, outside of that weird pandemic period in 2020. That's a huge shift.
It is. But despite this clear slowdown, we've got this persistent inflation issue. It's a bit of a puzzle. We're seeing inflation measured by the PCE price index, that's the Fed's favorite gauge, actually start to tick higher again.
Yeah, it seems totally counterintuitive, doesn't it?
It does.
And some of that, like you mentioned, is things like high tariffs pushing up costs for businesses. And there's another piece, too. Labor. Restrictions on immigration. They've led to a big drop, 341,000 in foreign-born workers, and that's pushing labor costs up slightly. So you've got this weird mix. Slower growth, but also rising prices in some spots.
So facing this, it looks like the Fed is putting a higher priority on the slowing economy, on the job growth slowdown. Their thinking seems to be that slower growth will eventually put a lid on inflation. Right now, Fed policy is seen as restrictive. The interest rates are high enough to deliberately cool things down. So these rate cuts they're talking about, they're not really aiming for a boom. It's more about getting policy back to a neutral setting, not hitting the brakes so hard, but not hitting the gas either.
Okay, so if you're keeping score at home, those are the basic economic reasons the Fed is even talking about cuts. And that directly affects your future borrowing power, right? Now let's pivot, because there's something else going on that's really shaking the foundations of how monetary policy usually works, and that's the Fed's independence. It's supposed to be impartial, data-driven, but lately, it's under intense political pressure. We're seeing the sustained push from the White House for really aggressive rate cuts. President Trump, for instance, has been very public, criticizing Jerome Powell, the Fed chair, calling him a stubborn moron, demanding massive rate reductions. That's strong language.
Very strong. And that kind of direct public criticism, it's definitely intensified the scrutiny on the Fed's independence. What's maybe even more telling is that the Fed's leadership, which is usually pretty united, is showing some real cracks. You look at the July 2025 Fed meeting, two governors, Christopher Waller and Michelle Bowman, they actually dissented, voted for a quarter-point rate cut when the others didn't. That was historic. First time since 1993 we saw that kind of open dissent on a rate decision. Shows real division.
And the politics isn't just about criticism or disagreements inside the Fed. There's personnel stuff, too. Governor Adriana Kugler stepping down early, August 8th, 2025. That opens up a spot sooner than expected for the White House to nominate a replacement. And some sources are saying, look, this new nominee, they could even be a frontrunner to be the next Fed chair when Powell's term is up in May 2026. So this isn't just filling one seat. It's potentially shaping the Fed's leadership for years to come.
That's a really important point. And President Trump has already floated names for Powell's successor, Christopher Waller, who we just mentioned dissenting. He's on the list, seen as, market-friendly, data-focused. Then there's Kevin Hassett, described as a, quote, Trump loyalist with a dovish economic agenda. Some even called him a yes man. And Kevin Warsh. He used to be seen as a hawk, but recently shifted more dovish. His close ties to Trump, though, definitely raised those politicization concerns again.
And adding another layer here, Stephen Miran. He's been nominated for Kugler's seat. He was actually an architect of Trump's tariff policy. Miran has talked about wanting sweeping reforms at the central bank. Some worry he could be a shadow over Powell, maybe even aiming to change the Fed's actual charter, its fundamental rules.
Right. And the big risk here, the underlying danger, is this sort of unwritten assumption that might develop, that the Fed's rate-setting committee will just, bend to whatever the White House wants. And research on this is pretty clear and pretty sobering. Political pressure on the Fed, it tends to strongly raise inflation and inflation expectations. But surprisingly, it doesn't do much for actual economic activity. Think back to Nixon pressuring Fed Chair Arthur Burns in 1971. That political interference, it led to prices being 5% higher after just 4 years. And if that kind of pressure lasted, it could permanently push the U.S. price level up by over 8%. That's a huge long-term hit to your purchasing power, baked in by politics.
Wow. And it's not just inflation, is it? There's this other concern that a Fed worried about politics might hesitate during a crisis, like being unwilling to open swap lines with other central banks. These are crucial agreements where they exchange currencies to keep money flowing globally. If those aren't used because of political fears, it could make any financial crisis much, much deeper, really amplify the damage.
Which begs that really important question. What does a less independent Fed actually mean for the stability of the whole financial system?
That's the million-dollar question, isn't it? And it leads us right into what these shifts could mean for your money, your financial future. Let's switch gears from the politics to the practical side. First up, fixed income, bonds. Generally speaking, when interest rates are falling and the economy slowing, that usually means positive total returns for bonds. We already saw Treasury yields drop after that weak jobs report. The 10-year benchmark yield fell pretty sharply, down to 4.23%.
Right. So for your bond portfolio, the general advice right now is to maintain what we call an intermediate-term average duration. Duration just means how sensitive a bond's price is to interest rate changes. Intermediate, think 5 to 10 years, balances potential gains from falling rates with risk. And you want to stick with high-quality stuff. Treasuries, investment-grade corporate bonds, top-rated municipal bonds. Probably best to limit exposure to lower-quality bonds like high-yield or junk bonds. A slowing economy puts more stress on those issuers.
And what about the yield curve, that relationship between short-term and long-term rates?
It's likely to stay positively sloped, maybe even get steeper, which means long-term yields might not fall as much as short-term rates. Why? Well, those inflation pressures we talked about are still lurking, plus the government needs to borrow a lot of money. That tends to keep longer-term rates somewhat higher.
Okay, makes sense. Now, what about stocks? Equities.
Okay, so lower interest rates or lower discount rates, as analysts call them, tend to boost valuations for stocks, especially high-growth sectors. Think technology, renewable energy. Lower rates make their future profits look more valuable today. So the expectation is that the tech-heavy parts of the market, like the NASDAQ, could outperform.
And this is where understanding these dynamics can really help you adjust your strategy. Beyond just tech, there are other sectors sensitive to interest rates that could benefit. Utilities, real estate, industrials, financials, even consumer discretionary stocks. These are areas that often get a lift when the Fed turns dovish.
And a dovish Fed, one that's cutting rates, might also stir up some inflationary expectations. Historically, that tends to be good for things like gold and energy. Gold, especially, could see more demand as a hedge. Insurance against inflation or maybe policy mistakes.
And currencies. What happens to the dollar?
Well, a dovish Fed usually means a weaker U.S. dollar, particularly if other major central banks are keeping their policies tighter. A weaker dollar can actually be a positive for emerging market stocks and currencies, makes their exports cheaper, eases their dollar debt burden.
Okay, but it's not all smooth sailing, is it? There's a note of caution here, too.
Definitely. Markets are getting ready for, well, more unpredictable policy moves. This intense focus on every single economic data point, it could actually keep market volatility high. And history gives us a bit of a warning label here. Looking back, after the Fed started cutting rates, the S&P 500 gained, on average, 23% over the next year if the economy avoided a recession. But if a recession did follow the rate cuts, the average return was actually negative 4%. So it really matters why they're cutting and what happens next. Big difference in outcomes.
That really highlights the uncertainty. Okay, to navigate all this, it helps to speak the Fed's language. A big part of that is understanding hawkish versus dovish. Can you break that down?
Sure. The Fed has what's called a dual mandate, two main goals. One is controlling inflation, that's the hawkish side. The other is maximizing employment, that's the dovish side.
So hawkish means fighting inflation.
Exactly. A hawkish Fed prioritizes keeping inflation low. Their tools, raising interest rates, selling government bonds, maybe increasing bank reserve requirements, all designed to tighten the money supply, slow things down a bit to cool prices.
And dovish is the opposite focus.
Right. A dovish stance prioritizes low unemployment and economic growth. So they do the opposite. Lower interest rates, buy government bonds, maybe lower reserve requirements, trying to stimulate the economy, boost activity, create jobs, even if it risks a bit more inflation. But it's not always black and white. Policymakers can be neutral or centrists. And within the FOMC, the committee that makes the decisions, those 12 members, they often have different views on what the economy needs. That's where the debate happens.
And these stances, hawkish or dovish, they really do trickle down and affect almost everything in your financial life, don't they? I mean, they influence the prime rate banks use, which hits your mortgage rates, car loans, even what you earn on savings accounts or CDs. Lower rates from a dovish Fed mean cheaper borrowing, which encourages spending. Higher rates from a hawkish Fed means saving looks better, borrowing costs more.
Precisely. You connect directly back to your wallet.
Okay, finally, let's touch on a tool the market uses to guess the Fed's next move. Fed funds futures. What are these exactly?
Right. Fed funds futures, they're basically financial contracts traded on an exchange, the CME group, and they're based on the federal funds rate. Remember, that's the key overnight rate banks charge each other. The prices of these futures contracts reflect what the market, collectively, expects that rate to be in the future.
So how does that help us? How do they work?
Well, you can take those futures prices and convert them into probabilities. Like, what's the market betting on the chance of a rate hike or a cut of a certain size at the next Fed meeting? It gives us a real-time snapshot of market expectations. It's like seeing where the money is being placed on the Fed's next move.
And what are they saying right now?
Right now, the signal is very strong. The CME FedWatch tool, which tracks this, was recently showing something like a 90.4% probability of a quarter-point rate cut. That's 25 basis points at the September 2025 meeting. And looking further out, the market seems to be pricing in the federal funds rate falling all the way down to around 3% by the end of 2026.
Wow, 90% probability for September. What does it tell us when the market is that certain or predicting moves that strongly?
It suggests a really high degree of consensus among traders and investors. They seem convinced that the economic slowdown is real and that the Fed basically has to act. It's not just a wild guess. It reflects a deep reading of the data, the Fed's past behavior, and maybe even that political pressure we discussed.
Okay, so quite a journey we've taken. We've looked at the cooling economy pushing the Fed towards cuts, the very real political shadow hanging over its independence, and what this might mean for your bonds, stocks, your overall finances. It's definitely a complex picture, lots of moving parts. But hopefully, armed with these insights, you feel a bit better equipped to understand what's happening.
And maybe one final thought to leave people with. If we connect this back to that historical evidence, the data suggests political pressure tends to boost inflation more than it actually helps the economy long term. So you might ask yourself, this push for maybe short-term economic gains driven partly by politics, could it ultimately lead to bigger problems for price stability, for your financial well-being down the road?
That's definitely something to think about as you watch things unfold. This was another deep dive looking into the material you shared. We hope it sparked some aha moments for you.